WTI crude oil futures dropped 1.6% on Friday, closing around $67 per barrel, marking a weekly decline of nearly 1%. The drop reflects growing concerns about a potential supply surplus in 2025, which overshadowed OPEC's recent moves to delay planned output increases and extend its production cuts until the end of 2026. OPEC, a coalition that accounts for nearly half of global oil output, has decided to maintain its current production curbs and delay any gradual rollback of these cuts until April 2025. This decision is seen as a response to mounting challenges in the oil market, including subdued global demand especially from China and increasing production from non-OPEC countries, both of which have forced the group to repeatedly revise its plans. Despite these measures, the outlook for the oil market remains bearish, with analysts projecting an oversupplied market in the coming year. HSBC has lowered its surplus forecast, now predicting a smaller surplus of 0.2 million barrels per day for 2025, down from its earlier estimate of 0.5 million barrels per day. Similarly, Bank of America expects growing surpluses to put downward pressure on prices, forecasting that WTI crude will average $61 per barrel in 2025. This comes even as the bank anticipates a rebound in global oil demand growth to 1 million barrels per day next year. These forecasts highlight the delicate balance OPEC faces as it tries to stabilize prices while grappling with shifting market dynamics, where non-OPEC supply growth and uneven demand recovery continue to challenge its efforts. Furthermore, U.S. rig counts have increased for the first time in 8 weeks, suggesting a potential uptick in production even as global demand shows signs of softening. The market remains under pressure from bearish fundamentals, with prices failing to breach key resistance levels of $70 and $72. Traders are increasingly eyeing downside risks as the path of least resistance points lower. A break of $66 with strong selling pressure could accelerate losses toward the critical support zone near $62. U.S. natural gas futures slipped toward the $3 mark following the release of a smaller than expected storage drawdown by the EIA. Utilities reported a withdrawal of 30 billion cubic feet of natural gas for the week ending November 29, falling short of market forecasts of a 43 billion cubic feet draw. This left storage levels 284 billion cubic feet above the 5-year average, reinforcing bearish sentiment. Natural gas prices have fallen over 8% this week, largely driven by weather forecasts signaling a shift from colder than normal conditions through December 7 to warmer than normal patterns thereafter, which could curb heating demand. On the supply side, U.S. gas production averaged 102.3 billion cubic feet per day in December, up from 101.5 in November but still below the record high of 105.3 billion cubic feet per day set last December. Meanwhile, the U.S. gas rig count has risen for the second consecutive week, indicating a potential increase in production amid signs of strengthening global LNG demand. Looking ahead, analysts anticipate production to ramp up in 2025, spurred by stronger LNG export demand and recovering prices. Supporting this trend, feed gas deliveries to major LNG export facilities have averaged 14.2 billion cubic feet per day in early December, up from November's 13.6, nearing all-time highs. The market appears set to end the week on a bearish note, with prices staying confined to the short-term retracement range of $3.10 to $3. A sustained rally above Friday's high of $3.10 would confirm a breakout to the upside, though this will likely hinge on updated weather forecasts over the weekend indicating colder than expected conditions. On the other hand, if warmer trends persist, prices may slide lower, potentially establishing $3 as a critical resistance barrier instead of support. Please like, subscribe, and comment to support the channel. See you in the next one.